So let's talk about down payment assistance programs. Let's talk about all the different types of programs that are out there to help you purchase a home, the pros and the cons of those, because I think there's some misinformation or lack of information is given. And anybody who's buying a home, you need to know not only what you can access, but how it affects you now as well as in the future. I'm not saying that anything is bad or one thing's better than the other, but it's a question of for you in your specific situation, what is going to benefit you most? So one of the biggest things out there is the Genoa down payment assistance program. There's other ones like it, but Genoa is one of the easiest to get through because you have a lot of lenders who will facilitate that in-house, which means that you don't have to wait for your first loan to get approved and then wait for the grant or the down payment assistance program in order to get approved, which causes delays. And even though we're sitting in December 2022, things aren't as crazy as what they were this summer. We're going to see that all come back in again fairly soon. I would expect by the end of spring, which means that if you have a down payment assistance program on your offer letter, you're going to get passed over because of the amount of time that can be taken with it. Whereas if it's all done within house, then it's not as much of a delay, and most sellers agents know and understand what you need to know. So Genoa will do a down payment for a 3.5% and 5% down. When you're looking at down payment assistance programs, please, I need you to look for when they say 10-year terms, 30-year terms, 120 payments, 36 payments. This is an indicator to you that if you refinance this loan before those timeframes, you have to pay everything back. Some of them also have a graduating reduction in what you owe for that down payment assistance. But keep in mind, all down payment assistance programs are not the same. Most of them have ways that the lender or the grant is going to get paid back because they need to be able to have more funds to be able to lend more money. They're not doing anything shady. They're not doing anything crazy, but there's only so much funding that they can give out without finding ways in order to get it back. So when you see that it says 0% interest, 0 APR, that means you don't have to make a payment on it. For the 3.5, after 36 consecutive on-time payments, it goes away. So you get to keep this loan for 3 years, no matter what the interest rate is, in order for that to be forgiven. For the 5.5, after 120 payments on the first mortgage, then it's forgiven at the 5%. So anytime you're reading through these, please pay attention to those different things. Rates from the other day when I pull the information, rates change daily, sometimes hourly, but this is the 5% down DPA with a 600 credit score, which Genoa does do. So your par rate, you're either going to pay $338 to get a 7.375% interest rate, or you're going to pay 7.5% interest rate, and you're going to get a credit of $338. So the way that this changes the monthly payment in between the two is about $23 in between the two. However, if you come all the way up here, you can get $2,000 worth of lender credit. And you're looking at a 7.5% interest, or 7.75% interest rate, and your payment goes to $1,934. Versus if we're not doing a down payment and we're looking at a 600 FICO score, your par rate is 5.5, and you only have to pay $84 in order to get it, or it's a 5.625, and you're going to get a lender credit of $1,218. So when I'm working with a client, they don't have a lot of cash to close. I'm looking at both the down payment assistance program versus not utilizing it and getting them lender credit. In both of these cases, the lender will not pay the loan officer's fee, so you have to pay it. Now, I'm on the wholesale side. There's a lot of retail lenders out there, so a lot of things that they do are a bit more expensive and adds more to your closing costs. But when you're looking at how much money this is saving you, so if you're looking at a 5% down, let's say I did this based off of a $275,000 loan times 0.05, you're looking at $13,000, right? Between lender credit and seller assist, so if I take you to a 6.25% interest rate, I can get you $4,600 worth of lender credit. and go higher and get you $8,000 with the lender credit. But I can take you to here to 6.25, and now your mortgage payment is 1663 before we add in PMI. And this loan in 6 months, you can refinance down to the lower interest rate. You got to look at the pros and cons that go in both directions, because if I can get you $4,600 in lender credit and your realtor can get you another 6% in seller assist, that's not always that often, but sometimes you've got a really good realtor who can negotiate that. So on a $275,000 loan, that's $16,500. Let's say they're only able to get 4%. It's $11,000. That's getting you all of your closing costs. So the lender credit and seller assist can only go towards your closing costs. It can't go towards your down payment. But on a $275,000 property, on an FHA loan, it's only $9,600. So when everybody works everything out the right way, this might be a better opportunity for you versus going with the down payment assistance program, because as soon as the interest rates drop, I can refinance you out of it and do a streamline. The great thing about the FHA product is when I do a streamline loan, it's no appraisal. It's like 15 days. It's limited paperwork. It's easy and good to go. So another down payment assistance program is from another one of my lenders, because again, some lenders do it. Sometimes they major programs. There's all sorts of different things that come into it. This one, they're requiring a 620 credit score. Your income has to be equal or less than 140% of the state or county median income. It is for first responders, police officers, firefighters, public safety officer, paramedic, emergency medical technician, including volunteers or similar. So this actually covers a lot of people: educators, medical personnel, civil servants, military personnel, first-time home buyer, or subject property located in an underserved census tract. You don't know what that is? Look that up. It's an area where they don't find a lot of people buying homes or getting approved for homes. This works for a 1 to 4 unit, manufactured home, FHA approved condos, PUDs. This one does not have a certain amount of time that you have to keep the loan in order to not have to pay it back. Certain amount of time that you have to pay the high fees, which is a beautiful thing. But if we come down, we take a look at the difference in what it's going to cost you. You're looking at, so at the 7.75% interest rate, it's going to cost you, you're not getting any lender credits. There's not a par rate on this at all whatsoever. This one, and this is why when everybody talks about buying down points and all that stuff, you can't, until you're looking at a pricing spreadsheet, figure out what that actually looks like. Because in this case, the higher interest rate is costing you more than if we come down to the 7.25. This is only costing you a little bit over 2 points. And your monthly payment before taxes, homeowners insurance, and any PMI, you're looking at $1,810. This requires a 620 FICO score. It's a 3.5% down payment, but there's no lender credit to be gotten here. Versus if I come over here, we have par rates of 5.375 versus 5.5. We have lender credit that we can get at 6.25 of 45.53. This was also done at a $275,000 price point. This was also done in both cases for Delaware County. I didn't put in debt to income ratio. I didn't put in reserves. I didn't put in any of that stuff. But when you're looking at getting $4,500 worth of lender credit, and then you add in seller assist, your monthly payment difference for just your principal and interest, $1,663 versus $1,810. This one, again, if you do this one, you have to bring your down payment. Your closing costs are going to get covered by the lender credit and by seller assist for however much your realtor is able to get. Now, outside of those, another thing that I've been hearing a lot about is Dollar Homes on HUD, Good Neighbor Next Door. There are tons of programs out there. The problem is the availability for those programs. So they all sound great. They all sound beautiful. But what happens is we haven't really seen any inventory for those since the housing crisis in 2008. And considering the fact that they changed the regulations on what you have to do in order to get approved for a mortgage, and they got rid of the predatory lending, and they created a lot more structure, which annoys a lot of people, but it helps to keep people safe when they're purchasing a new home. You're not going to find many of those homes. So let's take a look over at that website, and that's going to be homeownership assistance programs. You can pull that up on HUD itself as well. In here, you go to whatever state you're looking at. So the first state I'm licensed in is going to be Delaware. We're going to say Dollar Homes, and we're going to search. 0. We're going to go down to Florida, and we're going to search. None. We're going to go down to Maryland. I'm also licensed there. None. We're going to go down to New Jersey. None. We're going to come down to Pennsylvania. And still none. Okay. Well, there's other ones. So we have Good Neighbors Next Door. That's if you're a teacher, EMS, police officer, there is a program for you in order to purchase a home. Now, Good Neighbor Next Door is a little bit different because there's certain home areas that they will allow that to be done in, because it's there to help stabilize certain neighborhoods and make everybody happier to be there. Pennsylvania, none. New Jersey, none. Maryland, none. Florida, none. Delaware, none. And I seem to have forgotten my lovely state of Virginia. No Good Neighbor Next Door, no Dollar Homes. These only happen when there's a lot of inventory and there's a lot of foreclosures. And at this point in time, we're not even at pre-pandemic levels for foreclosures, because what happened was during the pandemic, we allowed people to go into forbearance if they were having a hard time paying their mortgage. We also had stimulus money on top of additional money that was coming in, on top of tax returns and people not going out and not spending as much money. So people were able to get right side up on their mortgages and get caught up and get things put together a lot more than they would have been had the pandemic not happened. Then you add to that the fact that there was a foreclosure moratorium for a very long period of time. Same thing with rents. And the number of foreclosures that are coming through are not that much. So programs like this, while they're great, the HUD programs for Dollar Homes and for Good Neighbor Next Door are not going to be available. Feel free to keep checking and prove me wrong and post that you prove me wrong. I'm happy if you can. There's a NACA program. NACA is actually a really cool program for first-time home buyers. They take you through everything. They show you how to get your finances under control. The hard part with NACA is in many areas, they've got a 6 months waiting list before you can speak to an advisor. And they have certain guidelines that you have to hit, because any type of down payment program or what have you is going to require a lower DTI in order to make it less of a risky loan for that specific company. But NACA is fabulous. I don't have access to it. It's a specific program. It's facilitated by Bank of America, and I think it's a good one for people to check out. USDA is one of my favorite loans. It's 100% financing. The house and the household has to qualify for it. So a lot of people think that USDA loans are very hard to find. You have to be out in the middle of nowhere. And that's not even remotely. You'd be surprised the areas that it comes into. But the thing about USDA is they take account the income for every person in the household. So if you got a 10-year-old with a paper route, that person, that income, it has to get counted, and everything has to fit underneath the area median. Everything that's a light area. So here's Pennsylvania. There's even parts of New York and Connecticut. Outside of Philadelphia, there's lots of parts of New Jersey, lots of areas in Delaware and Maryland. Is it more rural than being in Philly? Absolutely. Is it out in the boondocks? No. Virginia, lots of areas. I'm not in the Carolinas or Georgia, my home state of Florida. Look at all these light areas. Look at all these light areas in the middle of the state. Those areas are all USDA available. Now, one other thing to know too is that if an area was designated as a declared disaster area, there is a loan called a 203H loan for a presidential declared natural disaster area. Those areas, you have up until a year to utilize this loan. It's 100% financing with rehab built into it. It doesn't mean that the house has to be down to the ground. It doesn't mean that it has to be completely destroyed. But if you find a house in a presidential declared disaster area, whether it be from tornadoes or hurricanes, which is where the H comes from for a lot of people, earthquakes, things of that nature, you can use the 203H loan for 100% financing with rehab. Again, there's nothing wrong with any of these loans that help you get into a house, but you don't need 20% down in order to get into a house. You do need anywhere between 0 if you're using VA or USDA to 3% on a conventional to 5%, depending upon where your income is and if you're a first-time home buyer. You need cash to close, and your cash to close is your down payment and your closing costs. And your closing costs vary depending upon if you're dealing with a retail or a wholesale lender. It varies whether you're dealing with somebody like me who's a broker and I make the lender pay the majority of the fees, or if you're dealing with a direct lender, they don't have those options. It makes a difference who you use for your title company or your title attorney, which is 100% your choice, and where we are as far as taxes and homeowners insurance have to be. So for most of my areas, with the exception of Florida, I estimate about $125 a month for homeowners insurance. Florida's more because unfortunately hurricanes and things of that nature. My house in Florida, my homeowners insurance is $1,600 a year, which isn't bad. I've seen them as high as $2,500. And your property taxes. Your property taxes are going to make a huge difference as to what you qualify for. And always make sure you find out from your loan officer when they're doing their estimations as to what you're qualified for, what they're using for the property taxes, because a $2,000 swing in property taxes can make a difference of $50,000 to $75,000 in your purchasing power. Because you got to remember, the purchase price of the house is divided by 360 and then interest is added onto it. Property taxes and homeowners insurance is divided by 12. Makes it a much bigger swing all the way through. But whenever you're looking at down payment assistance program, have your loan officer look at it as if you weren't and you were getting lender credit versus doing the down payment assistance program, so that you can compare and contrast as to how it's going to benefit you. Make sure to find out if there is a prepayment, to where if you pay it off within the first year, if you're going to have to pay back that down payment assistance program. 9 times out of 10, you're going to have to. Take a look at the interest rates and the fee differences between using down payment assistance program versus not utilizing it. Because there are programs that add additional fees to the back end. It's a riskier loan. They're going to get the money back in order to be able to lend out more money to more other people that need it as well. I'm not saying it's a bad thing, but you need to look at the total picture before just jumping into that. And remember, if you have any questions about anything, feel free to reach out to me. I'm always happy to answer anything and everything.